Hey, what's going on, everyone? Welcome to Macro Thinker, the channel that discusses finance, real estate, and investing. Today's video, we're going to talk about mortgage rates, which are on the rise. And it's something we want to look at really closely because it obviously impacts your purchasing power or the amount of savings that you get when you refinance. So we're going to talk a little bit about where they are today, where they're headed, and how it impacts your purchasing power or your savings if you refinance. My name is Lewis. Let's get into it. All right, so we're going to jump into an article by Mortgage News Daily, and it's titled, Mortgage Rates Are Now Well Over 3%. And don't get too scared here. Rates aren't, I wouldn't say they're well over 3%. They're maybe in the upper twos to low threes, depending on how you qualify. But let's take a look at what the article says here. So it says, mortgage rates wish they were still at 2.97%, the number conveyed today by Freddie Mac's weekly survey. So the Freddie's data is accurate when it comes to capturing broad trends over time, but it can really fall short when the bond market is experiencing elevated volatility. To say the bond market volatility has been elevated recently is an understatement of extreme proportions. Things are happening that haven't happened in years. Some measures of volatility rival the March 2020 panic surrounding COVID, only this time there's no catalyst other than the market movement itself. Today was by far the worst of a bunch when it comes to this most recent spat of volatility. Any mortgage lender added another 0.1% to their 30-year fixed rate offerings. Over the course of the past week, most lenders are up 1/4 to 3/8 higher. And compared to the beginning of last week, many lenders are a full 0.5 point higher. In other words, what had been a 2.75% is now a 3.25. All right, so I've mentioned this in prior videos, but just to reiterate, the mortgage rates tend to track the 10-year treasury yield in lockstep fashion. So if you see the yields go up, you'll see rates go up. If you see the yields go down, you're going to see rates go down. Now, I have the 10-year treasury yield up on the screen. You can see that it's a down day. We're at 1.448%, which is still a historic low in terms of the overall historical trend of the 10-year treasury yield. So up on the screen, I show the historical performance of this yield dating back to about 1980. And you can see that the yield was as high as like 15, 16%. And then it comes down. So we'll see a downward trajectory, and you can see that it's still sitting at all-time record lows. It's just not at the March 2020 low here. The question is that where is it going in the future? Well, we are anticipating future inflation due to the stimulus packages that are being passed and the overall strength in the economy, but we don't know how the Fed is going to act and if they're going to intervene and try to peg that yield to keep rates low and continue to buy these mortgage-backed securities. If they don't continue to buy those mortgage-backed securities, we're likely to see this yield rise, and we're going to see mortgage rates rise along with it. Why are rates rising so quickly? Here are a couple bullet points. Bond rates initially accounted for a bleak reality in mid-2020, and that reality grew less threatening in some ways by the end of the year and significantly less threatening in 2021. So in other words, they're anticipating future inflation, they're anticipating that the threat is going away, and rates are starting to come back up because we saw that huge dip in March of 2020, and now the trajectory has kind of been back up to a more normal level of interest rate. Case counts are plummeting in 2021, and vaccine distribution, while not perfect, is going fairly well. So the government is able to get the vaccine in people's arms, and that is hopeful for the economy and future growth. Future stimulus prospects increase dramatically with the Democratic sweep of Congress in early January, and fiscal stimulus puts obvious upward pressure on rates. Inflation metrics have been causing conversations about inflation returning to the stage as threat to interest rates after more than a decade being extremely subdued. The economy is doing better than many expected with respect to adapting to some of the new restrictions due to the virus. Optimistic attitudes about people being able to return to the workforce in greater numbers after widespread vaccine distribution, and a return to full-time in-person schooling. Now, to give you an idea of where the interest rates are in terms of historical numbers, they are still very low. So I have up on the screen here the 30-year fixed mortgage rate average in the United States, and it dates all the way back to about 1970. You can see here that it peaked in 1983 and has been on a downward trajectory ever since. We're literally sitting in 2021 at still all-time record lows, making it a great time to secure that 30-year fixed rate debt. So the question is, if we were at 2.75% on a 30-year fix and today we're at 3.25%, what's the difference in monthly payment and how does that affect your ability to qualify for a mortgage? So let's take a look at that real quick. Up on the screen, I have a mortgage calculator, and we're just going to type in a $400,000 loan, which is pretty common here in California. And we're going to type it in a 2.75% 30-year fixed rate just to get an idea of where the monthly payment is. Now, your principal and interest payment on that would be $1,633. And let's look at the difference between that and 3.25%. All right, so pull up a calculator here. We were at $1,633, and with that 0.5% rise in the interest rates, we would be at $1,741. Which is $108 per month difference on your monthly payment. So $108 more, still historically a phenomenal interest rate, and does not make a dramatic swing in the payment for a loan amount that's $400,000. So that would be a loan amount that would be common in a California property because homes tend to be a little bit more expensive out here. But let's say you're going back into maybe some of the states in the Midwest where a $300,000 purchase or a $250,000 purchase might be more common. And let's say we have a loan amount of around $200,000. So if we have a loan amount around $200,000 and we're looking at a 2.75 rate, your mortgage payment, principal and interest would be $816. But if we bumped up to 3.25, we'd be looking at $870 a month. So you're looking at $54 a month difference between the 2.75 and the 3.25. Overall, not a dramatic difference. It's probably not going to impact your purchasing power too much, given the fact that we're about $50 off, and shouldn't really impact your ability to qualify for the purchase either. So with all that said, I want to leave you with some personal thoughts on where I think the market is headed. Yes, I do think the economy is doing better, and I think that people are hopeful that they're distributing the vaccine and we're starting to be a lot more productive and people are getting back into the workforce. With that said, I think that the Fed is going to do everything that they can to control these rates and keep them really low, and they're going to continue to buy these mortgage-backed securities, holding these rates low. So even though we are anticipating future inflation, I think that rates are going to stay relatively stable despite this recent increase in the 10-year Treasury yield and the mortgage rates. And you have to keep in mind that a rate at 3.25% or even in the high twos, depending on how you qualify, is still historically amazing. I mean, rates have not been this low ever. So even though we're not at the bottom of the bottom, we're still looking really good as far as securing financing goes. All right, so that's going to wrap up today's video. If you found the information useful, please consider hitting that like button and subscribing. When you like and subscribe, it tells YouTube to share the content to more people, and it really helps grow and promote the channel. Really appreciate you taking the time to watch. Thank you so much. You have a great day. Take care.